Welcome, everyone. Let me first say how grateful all of us at WHYY are to the many viewers, listeners, and members who've joined us here for today's program. My name is Adrienne Webb-Schulman, and I am WHYY's Plan Giving Officer, and I have the pleasure of working with many of you who are electing to include public media in your estate plan. I'll be your host today. As you all know, at WHYY, we are rooted in providing Greater Philadelphia access to news, information, and opportunities for lifelong learning. And in that vein, it's our great privilege to present today's program, Preparing for Your Family's Future, our Special Needs Trust Information Session. We're going to get started shortly, but I just want to provide a few short housekeeping notes. First, we're recording today's program, and we will be sharing slides and the recording at a later date with you by email. Second, thank you so much to all of you who submitted your very thoughtful questions in advance of the program. We are going to get to as many questions as we can today. We've received a lot of very relevant and timely questions, and we encourage you to continue to be in touch with us regarding those questions. We will be sharing the contact information for our partners today, Bryn Mawr Trust Wealth Management, after the program concludes, so that you can be in touch if you have additional questions. It is important to note that today's special guests are volunteering their time, and this is an opportunity to really provide objective information, and this presentation is not sponsored by Bryn Mawr Trust Wealth Management. So, another big part of WHYY is we always love to get audience feedback, and we will be sharing out a survey and would really like to get your feedback after the program, and we hope that you will provide that to us. We'll be sharing it via the Zoom link, and we'll also be sharing it via email. It also helps us determine topics for future webinars, which can be really helpful. So I'm going to get started with the presentation and sort of turn it over to our colleagues. Happy to specifically introduce you to Sheila Gibson, who is the Vice President and Wealth Advisor at Bryn Mawr Trust. She specializes in special needs trusts and guardianship at Bryn Mawr Trust. She has more than 30 years of experience, and Sheila manages dynamic family relationships and issues which exist in guardianships and special needs trusts. She also has extensive experience with Orphans Court and various counties in Pennsylvania. Sheila will be joined by her colleagues, Elizabeth S. Roberts, Chief Fiduciary Officer and Senior Vice President at Bryn Mawr Trust, and Deborah Hare, Senior Vice President, also from Bryn Mawr Trust. So take it away, Sheila. Thank you so much for joining us. It really, really, really means a lot that you're taking your time to be here with us today.
Thank you, Adrienne. Good afternoon, everyone. And thank you for having us today and allowing us to speak on this topic. Over the years, in my capacity as a guardianship and special needs trust administrator, I have spoken with many individuals about their child's special needs. Many families with loved ones with disabilities know that they need some type of planning, but hesitate to do so. It can be an emotionally charged and difficult discussion amongst family members. However difficult, it is a necessary discussion. I recall striking up a conversation with someone in a local pharmacy. We eventually got around to what I did for a living. Usually when I tell a person that I'm a guardianship and special needs trust administrator, it normally leads to several questions about my profession. Mostly it results in a discussion about their own personal situation. During this conversation, my new acquaintance advised me that he had a daughter with special needs. I asked if he had a plan in place, but when he would not take care of his daughter. His response was not surprising. He said his wife did not want to really discuss it, so they didn't have a plan in place. It was just assumed that a family member would step in. I advised him that although it was difficult, it was a necessary discussion that should not be put off. He nodded in affirmation. Later, I ran into him again in the neighborhood, and he thanked me because he had taken my advice and had called his family attorney. Elizabeth will introduce you to today's program.
Thank you, Sheila. The story Sheila just told is reflective of the fears of so many distressed families who wish to care for their vulnerable loved one, families who do not know where to turn, and families who are even afraid to ask the basic questions and seek advice. Today, thanks to Adrienne Webb-Schulman and her team at WHYY, we will provide some answers to your questions as to where to turn and what questions to ask so that you, along with your personal, financial, and legal advisors, can devise a plan suited to your particular situation. So next slide, please. With my name, as Adrienne has already said, is Elizabeth Roberts. I'm the Chief Fiduciary Officer at the Bryn Mawr Trust Company. In this role, I oversee the administration of trusts, including special needs trusts. I've been with Bryn Mawr for over 10 years. Before that, I was an attorney in private law practice for more than 15 years, during which time I limited my focus to the area of trust and estates law. You have already met Sheila Gibson and heard about her extensive experience in this area. Sheila will speak to you again throughout the program about some of the details of special needs trusts and their creation and administration, even through their termination. Our other panelist today is Debbie Hare. Debbie is a senior vice president and a senior wealth advisor who has spent 25 years in financial services. Debbie is a very experienced planner, administrator of trusts, and facilitator of family conversations. Debbie will provide you an introduction of basic key concepts. These key concepts are building blocks to our discussion of S&Ts. In addition, Debbie will discuss the economics of S&Ts, not only as to the beneficiary, but also as to the caregiver. The three panelists bring a different but interrelated perspective to S&Ts. While the focus may shift from time to time, no one area is more important than the other when reviewing the situation as a whole. This is a model you will hear throughout our discussion today. It is also a model we suggest you adopt. Throughout the presentation, Sheila, Debbie, and I will answer questions which we have already received from you, as well as questions we receive during the program through the chat function. If we do not respond to your question, just as Adrienne said, we will follow up after the program. Our aim is not to make you experts in the field of S&Ts, but rather to provide you a broad overview with basic concepts so that you can start an informed dialogue with your own financial and legal advisor. Please note that many of the rules and regulations in the area of special needs trust and at times public benefits in general are state specific. For this reason, during our presentation, we will aim to alert you to items which are state specific. While we know the WHYY audience extends throughout the tri-state area and perhaps geographically beyond, given the volume of the material, our focus during much of today's discussion will be on Pennsylvania law. In addition, some of the questions are very fact-specific. For these questions, we will answer as best we can with some responsive guidelines or next steps. Please note that given the time limitations and our respective fields, we may not be in a position to respond to questions which extend beyond the scope of special needs trusts. Some of these areas are as qualifying for public benefits in general medical, Medicaid planning, or elder law issues. Finally, you will receive materials, as Adrienne said, after the program. So we ask you to review those if you have further questions as well. So with these ground rules and understanding, let's get started with Debbie and one of the questions we've already received from the audience.
Thanks, Elizabeth. and good afternoon to the audience. I'm pleased to have the opportunity to speak with you today, and thank you to the participants who are joining us. As Elizabeth mentioned, this program is intended to be a resource to help families navigate the maze of special needs planning. We're about to cover a lot of information today, and we'll make sure that the audience receives our materials. Let's go to the next slide, and the first question represents a good starting point for us. I want to set up a special needs trust for my brother with special needs. Can you please go through the basics so that I can acquire this for him? Next slide, please. As Sheila highlighted, planning for an individual with special needs is challenging for families, but it is an essential part to ensure that your loved one receives the quality of life that they want and you desire for them. Many audience members are interested in how to establish a special needs trust, and it starts with a holistic approach. There are three main categories that require thoughtful consideration. First is legal planning, and that entails a comprehensive estate plan for both parents, who are often the caregivers, and perhaps a special needs person. It may also include establishing a special needs trust or obtaining a guardianship. The next is financial planning, and that includes estimating the cost of lifetime care, understanding the governmental benefits available, and evaluating the family's ability to provide financially. And care management, which includes assessing needs and planning for the phases of life, and finding opportunities to cultivate social relationships. Starting this process early makes for the best outcome with steady progress. Our experience is that circumstances are different and all have their own complexities, as with this next question on our next slide. I have a son who has special needs. He has struggled with addiction for 15 plus years. I cannot leave him cash in my will, as I think he will not be responsible with it. Should I place my investment portfolio in a trust with distribution to all three children without touching the principal? Let's move to the next slide on trust terminology. Families with special needs face many challenges, and it's difficult to know which decision is the best. Throughout this discussion, we will address the various issues that this audience member raises. To start, the discussion around legal planning and trust creation, we want to provide the audience with some terminology as we build on concepts and strategies to help you and your loved one. When a person uses the word estate plan, it's referring to the documents that protect a person's assets and property, known as estate. A will is a legal document that sets forth your wishes. It can be effective upon your death regarding distribution of your property. And it will also include provisions regarding care of your minor children. A trust is an agreement between a person who creates it and the person or entity that will manage it in accordance with the terms. A trust agreement establishes intent or purpose of the trust, the parties involved, and how the trust is supposed to be managed. Elizabeth, would you like to offer a little bit of context around the term fiduciary that we'll use throughout the presentation?
Thank you, Debbie. As we will discuss in further detail, both a will and a trust require a fiduciary to handle or execute on the directives and provisions set forth in these documents. A fiduciary is a person or qualified institution which has a duty as a result of agreeing to assume a role to act primarily for another's benefit. In the case of a will, the fiduciary is an executor who's sometimes known as a personal representative or administrator. An example of variation from state to state. In the case of a trust, the fiduciary is known as a trustee. Again, with variations on that name for whether serving as a successor trustee, an independent trustee, and other such variations. In all cases, these persons or institutions are known as fiduciaries. And when we refer to institutions, I'm referring to a qualified bank or a trust company. Now that we have key terminology, we will move to the next slide that illustrates 5 documents that will be found in a traditional estate plan. Debbie, can you tell us a little bit more about that?
Perfect. Thanks, Elizabeth. And we are on the right slide, which is really kind of talking about the components of estate plan. And building on the concepts that Elizabeth has mentioned, on this slide, you'll see that there are 5 basic documents utilized in a traditional estate plan. These documents are necessary for parents, guardians, and adult family members that are supporting a person with special needs. In this part of the presentation, we're really going to focus primarily on wills and trusts, as illustrated at the top. And then at the bottom of the slide, you'll see various types of powers of attorney that can help prepare an individual for the ability to appoint another person. So powers of attorney, we're going to discuss a little bit later. But I think one of the important things we should touch on is validity. And Elizabeth, I'll just turn to you to sort of help our audience understand what we mean when we say it needs to be a valid document.
Yes, you will want to make sure you have a current valid will in place that reflects your wishes. If you die without a will, your estate may pass to those designated under applicable state statutes and not in accordance with your specific wishes. In the case of the example in the question, which was read a few moments ago, the property may pass otherwise. It could pass outright to the child with addiction issues rather than being placed in a sheltered trust if you don't have a valid will. And when we speak about valid will, it's a will that would be recognized in the state in which you die domicile, the state where you're living and have firm residence. So there's requirements that vary from state to state. Now that we have the basics of estate planning, we will move to the next slide that illustrates parties to a trust. Debbie?
Perfect. On this slide, there are 3 main parties to a trust. There's a grantor, a trustee, and a beneficiary. A grantor is the person that creates the trust agreement with purpose and intention. A grantor can sometimes be referred to as a settlor or a trustor. And you can have more than one grantor creating a trust, for example, parents or spouses. A trustee is a person or persons or an organization, as Elizabeth mentioned, that executes on the intentions of the grantor and holds and administers property for the benefit of another. And a beneficiary is a person or persons who have a beneficial interest in the trust. So now that we understand the parties involved, let's go to the next slide and review how a trust operates. On the left side, you'll see that the grantor creates the trust by engaging an attorney to write a document that establishes a trust and naming a trustee and a beneficiary. The trust is represented in the center triangle. The trust is managed by the trustee at the top of the slide, and at the bottom of the slide, you'll see that funds are deposited into the trust. The trustee has control and discretion over the trust and manages in the best interest of the beneficiary or beneficiaries on the right. Elizabeth, I know you have some thoughts around how to pull these concepts together.
Sure. Let's return to the question posed by the audience member that started this discussion of wills and trusts and associated parties. If you recall, the audience member inquired whether to leave the entire estate, which I assume is the investment portfolio, in trust with distribution to all 3 of the children, since one of the children had a long-standing struggle with addiction. I think this audience member poses questions may be on the right track, but I may need to speak separately at some point. It sounds as though a trust may be the appropriate planning tool. You would certainly not want to leave the assets outright to this child. If you name multiple persons here, the 3 children, as beneficiaries of the income of this investment portfolio in a trust, then the income could be sprinkled among them. You need to be careful of including any provision in the will which mandates distribution of income or principal to a person with special needs. You will also need to do the planning Debbie suggested so far in her introduction, and which she will delve into in more detail as we progress with the program. You will need to ask, do I want to treat all 3 of my children the same? Is the income, which is traditionally interest and dividends, going to be enough? These and more are questions you should ask your financial and legal advisors as you work with them to find the answers appropriate to your situation. Debbie?
Thanks, Elizabeth. That was a great answer to a complicated question that was the question just before this one, which was basically you have a special needs child or person in your family and you have other beneficiaries you're trying to balance. So thanks for that answer on that. So we'll stay on this slide, and it's important to kind of understand the differences in the type of trust, irrevocable versus revocable, as this question poses. So we'll move to the next slide. And Elizabeth, why don't you kind of introduce that concept?
Okay. So this question is about irrevocable versus revocable trust for special needs. Which is best? In general, the irrevocable trust is preferred for someone with special needs trust. It is really the only option for a first party special needs trust. And that's one which you'll hear more about later. And that's a trust to be created with one's own assets. Many times is from medical lawsuit settlements. So even for a third party special needs trust, in most cases, they're going to have to be an irrevocable trust, a trust that cannot be changed. So before we turn to the specific of S&Ts, let's quickly review some of the different types of trust. Debbie, could you take us there?
Perfect. So on this slide, before we can review what a special needs trust is, we want to give a little bit of the information around a traditional estate plan focusing on wills and trust. And this slide highlights those estate planning documents that can be changed by the creator and are revocable, and some documents cannot be changed, and they are known as irrevocable. So this is really an important concept as we move into special needs planning, because more often than not, a special needs trust is irrevocable, meaning you cannot change it. On the left, the revocable trust is one that's created during a person's lifetime. It's also known as a living trust or an inter vivos trust. And this document can be changed during lifetime. The middle box represents a type of trust that can be created during lifetime. However, the grantor gives up the right to change the trust document for any material purpose. This document is irrevocable and is a very common vehicle for a third-party special needs trust that we'll get into. Lastly, on the right, an individual can create a trust under their will. This type of trust is known as a testamentary trust and becomes irrevocable, meaning you can't change it at the grantor's death. You can change a will anytime before your death, so long as you have capacity. This type of trust is important to recognize because we received questions from some grandparents who said, I need to protect my assets during my lifetime, but I want to give them to a special needs trust. After my death, you would use a testamentary trust or a trust under will in that circumstance. An important note on revocability is that if a person created a living trust, that's the trust that I'm referring to on the left-hand box, and a grantor passes away, the trust becomes irrevocable at their death and cannot be changed. So during a grantor's lifetime, they can change a trust. After their death, they cannot if it's a living trust. So returning back to the audience's question and restating Elizabeth's point, special needs trust can be created during lifetime or at death, and more often than not, they are irrevocable. So Sheila, our next question as we flip the slide moves into the specifics of a special needs trust. And this viewer asks, what is the difference between a special needs trust and a regular trust?
Thank you, Debbie. A special needs trust, S&T or supplemental needs trust, is a specialized trust that is created to allow the beneficiary with a disability to enjoy the use of assets held in trust for their care. The trust assets are not countable towards qualifying the beneficiary for state or federal government benefits. Those government benefits may include supplemental security income, Medicaid, rehabilitation services, and/or subsidized housing. We will cover social programs in this presentation under financial planning for your loved one. Going to the next slide, there's certain languages that is required in drafting a special needs trust. Let's look at some of the language which should be included. Your attorney will know to include certain language so that it will qualify as a special needs trust. This language will include providing for supplemental and extra care beyond those benefits the beneficiary would receive from the government. It will include language that the purpose of the trust is to supplement, not supplant, government benefits. For instance, Medicaid may cover the purchase of a customized wheelchair every 4 years or more. But in this instance, Chloe, who suffers from cerebral palsy, has gained weight and exceeds growth expectations and requires a new wheelchair after only 2 years. After appealing the Medicaid decision and receiving the denial, the request can be submitted to the trust to cover the cost of a new customized wheelchair based on the denial. In addition, Medicaid may not cover the accessories Chloe might want for her wheelchair, like LED lights along the side and the back of the wheelchair for visibility. By the way, Chloe wanted to upgrade to allow her to change colors. Let's not forget the neon purple wheelchair storage bag. Moving to the next slide, we'll discuss the different types of special needs trusts. On this slide, there are 3 types of special needs trusts. There is the first party trust, the third party trust, and the pooled trust. The first party trust must be established by the beneficiary, a parent, grandparent, guardian, or the court. In more recent years, under certain circumstances, the special needs person can serve as a grantor of the trust. The parameters for a first party are: the trust must be irrevocable. The beneficiary's assets must fund the trust. The beneficiary must be under the age of 65. A payback provision must be included in the trust document. An example of a first party trust is one where funds are awarded to a beneficiary as a result of a medical malpractice lawsuit. The beneficiary, age 22, will need means-tested benefits, including Medicaid, Medicare programs due to his injuries. The trust also includes a payback provision. The person should now be eligible to qualify for Medicaid and supplemental security income, or SSI, since his assets are in a special needs trust. They may use the trust to cover expenses not covered by Medicaid, which may include additional hours of therapy or additional incontinence supplies. For example, they may be an avid reader and use the funds for various magazine subscriptions and book clubs. The other type of special needs trust is a third-party special needs trust. It is a trust established and funded by a donor or parent, grandparent, or another relative or person. There is no age limit. There's no limit on the amount of money that can be used to fund this type of trust. The funds in the trust could be used for anything the beneficiary needs to supplement the benefits that they currently receive from the government. A payback provision is not required for a third-party special needs trust. Moving on, a pooled special needs trust can function as a first-party or third-party trust. It is a trust managed by a nonprofit organization instead of a corporate trustee. And it is a great option for those with smaller amounts to put in trust. The assets are managed as part of a group with separate sub-accounts established for each trust. Setting up a pooled trust provides the advantage of having the reliability and accountability of a permanent trustee over an individual trustee. It is very important to make sure that first-party self-settled trusts include specific language that the assets are to be used for the sole benefit of the beneficiary with a disability. Let's review again what the requirements are to qualify for a special needs trust in the next slide. In order to qualify as a special needs trust, the following must apply. The beneficiary must be under 65 at first party. The trust must be for the sole benefit of the beneficiary. The trust must contain provisions for the reimbursement to the Department of Human Services for the amount equal to the amount of Medicaid that was paid on behalf of the beneficiary, depending on the state or states in which the benefits were provided. The trust must be approved by the Department of Human Services General Counsel. An audience participant had a question we'll address in the next slide. What are the advantages of a special needs trust? To summarize, the advantages to establishing a special needs trust are the following. If properly set up and administered, the beneficiary of a special needs trust will maintain their eligibility for government benefits. The trust provisions ensure that the assets are used as intended to supplement care and needs. The balance of the trust assets are either paid back or distributed to the named beneficiary. Additional assets can be added to the trust. The grantor can name a trustee who knows the beneficiary and will watch over the assets and oversee distributions. It allows for the payment of expenses that improve the beneficiary's quality of life. I've mentioned naming a trustee in this slide. Elizabeth, another audience member had asked a question that you can address on the next slide.
Yes. That question is, what to consider when naming trustees other than aging parents who might be the most logical legal guardians in the short term? In the case of an S&T, especially a first-party S&T, many courts require that a corporate fiduciary be appointed. Remember, a corporate fiduciary is a qualified bank with trust powers or a trust company. The corporate fiduciary or corporate trustee would be required to have custody or to have some kind of control of the assets of the trust. If you don't have a corporate trustee in these circumstances, some state courts impose heavy bonding requirements. The requirement to lodge a bond can vary again from state to state and sometimes even from county to county within the state. I also see the question mentions trustee and legal guardians. These are two different positions. They're two different fiduciary positions. We will speak more about guardians in a few minutes. But first, as to choice of trustees, Debbie will review some considerations for trustee selection. The selection of a trustee can be key in establishing an S&T, but it's also key in creating and funding any type of trust. Debbie, your thoughts?
That's right, Elizabeth. Thanks for that. And let's just advance to the next slide when we talk about duties of a trustee. And when we review the responsibilities of a trustee, given that they are controlling and managing for the best interest of a beneficiary, it's important to understand what their functions are because it might help you select the right person or entity for the role. So as we mentioned, a trustee must follow the grantor's intent and the provisions of the trust. The trustee must prudently manage investments and they must exhibit sound decision-making and directing the assets for the beneficiary. They are to maintain detailed records, accountings, and file fiduciary income tax returns. They must communicate and answer the beneficiaries and respond to inquiries and provide information. They coordinate with advisors on legal tax and compliance matters. and they make sure that there is proper trust administration, which is critical for maintaining government benefits. And the trustee must maintain confidentiality. So now that we understand these trustees' duties, let's move on the next slide, which is considerations for choosing a trustee. We received a lot of questions on trustee selection. So on the left hand of the side, you'll see as an individual trustee, and on the right hand as a professional or corporate trustee. A grantor may decide to name a family member as an individual trustee. Your family knows the needs of your loved one, and it's sort of an obvious starting point for trustee consideration. It's important to make sure that they're prepared to assume the responsibilities with which they're being entrusted. Serving as a trustee is a commitment of a person's time over an extended period, and in many cases, decades. It's a good idea to make sure that the person understands what's involved. Professionals like accountants, attorneys, trust companies, or financial institutions regularly serve as trustees. Professional trustees have the knowledge, experience, and resources to offer consistency and a long-term solution to care for your loved one. Also, if you have difficult family dynamics or a high complexity in your family circumstance, it may present too much of a challenge to appoint an individual family member. In more complex circumstances, you may decide to name more than one trustee to share in the responsibilities. You can decide to name an individual to serve alongside a corporate trustee so that there are co-trustees. In this case, usually the professional trustee is responsible for all the financial matters, the bill paying, investment decisions, tax preparation, reporting, and the individual trustee is responsible for overseeing the professional trustee's administration. When drafting a trust document and naming trustees, and Elizabeth alluded to this earlier, it's important to consider a succession plan for your trusteeship, especially if you're naming a sole individual trustee. Your attorney will make sure that you name a successor trustee to serve if an original trustee can no longer serve or is unable to serve. Of course, cost is a consideration as well. We received questions on the cost of a corporate trustee's services, and generally it's based on a published fee schedule that is a certain percentage of the trust market value, with most trust companies requiring a minimum account value to be able to accept the appointment. An individual trustee can also receive compensation for their services, and the grantor can stipulate that compensation in the trust agreement. So for example, on a co-trusteeship, an individual trustee may receive compensation of 1/3 of the corporate trustee's fees. So we'll turn to the next audience question, which kind of moves us back to the basic estate planning documents and powers of attorney. Elizabeth, on this slide, the audience member questions, we're currently dealing with a critically ill parent that can't make decisions. Is it too late to move assets into trust?
Debbie, the short answer to this question is, it depends. First question you need to ask, is there a legally recognized decision maker in place? By this, I mean either a court-appointed guardian of the estate of the parent or an agent under a general durable power of attorney. These are both technical terms. In either case, there may be someone then authorized to act. And that person should immediately consult with an estate planning attorney with a focus on special needs trust planning. Throughout this presentation, or whenever we speak about planning in this area of special needs trust, the question of capacity arises. I think it would be helpful to have a simple definition of this term. First, the more simple one. Capacity is often a legal qualification, and it has been defined as an ability to understand the nature and effect of one's act. Now the more complicated one. Under Pennsylvania statutory law, an incapacitated person means an adult whose ability to receive and then evaluate information effectively and communicate decisions in any way is impaired to such a significant extent that such person is partially or totally unable to manage such person's own financial resources or to meet essential requirements for his physical health and safety. It's a long definition, and the courts really want to make sure in finding somebody incapacitated that there's no means for effective communication in the various provisions within that definition. Now, Debbie's going to speak to you about different types of powers of attorney, but as a preview, an agent under a general durable power of attorney would generally be able to act and make decisions on behalf of the parent. In addition, depending upon the totality of the facts and circumstances, if there is a court-appointed guardian of the estate of the parent, a court may, just may, approve such planning. And there again, it could depend on state law. This is why your own financial legal planner is needed, and that person needs to be aware of the special needs trust in this case, as well as general estate planning. Debbie.
Yeah, thanks, Elizabeth. That's great. And we'll stick on this powers of attorney slide, and then we're going to move into guardianship, which you just kind of brought to everyone's attention. And I'd say that, I mean, sort of threaded through this whole discussion is holistic planning. And that kind of brings us to the top of the discussion and a good slide for everyone to refer back to. So on this slide, you know, a power of attorney is a document that authorizes another person, otherwise known as your agent or attorney in fact, to help with their affairs. As illustrated here, powers can either be financial or medical, and they're part of that standard documents included in a basic estate plan that we mentioned earlier. In the audience member's question, if their parent had a valid, durable power of attorney, it would allow whoever in that document they named as their agent to manage their affairs. In essence, it gives the agent the legal authority to transact without needing court involvement. We commonly see durable powers of attorney used when a person declines due to aging, or if a person's had a serious accident or diagnosed with a serious illness. In these cases, before such an event occurs, the individual had to previously have capacity and sign a power of attorney. It's important to note that an individual without capacity cannot sign a power of attorney. A person with a special need or a disability may be able to sign a power of attorney based on their capacity. So we've discussed wills, trusts, powers of an attorney, but I think it's important to highlight the differences between a trustee and a power of attorney. So a trustee has authority over trust assets only. An agent under a power of attorney is not a trustee and has no authority over trust assets. They only have authority over non-trust assets. If you have a circumstance where you have both the trustee and an agent for your loved one, they often work together to share information, decision-making for the individual's benefit. So for example, a trustee will share the trust investment information so that the agent can file the personal income tax return. One last point on powers of attorney, and it sort of appeared in the question, is that powers of attorney are only valid during lifetime. They cease at death. So an agent's authority under a power of attorney ends when the individual passes away. However, after death, the executor under the will can obtain authority over non-trust assets. And that's a mouthful. And I am delineating non-trust assets because a trustee's role continues even after the death of a beneficiary or the death of a grantor. So in essence, in other words, a trustee's authority continues until the agreement's terminating provisions are met. This is helpful in special needs planning because it provides significant ease in administration. Elizabeth, I know you're always stressing the importance of powers of attorney, and this is an example where create one when you have capacity.
I totally agree, Debbie. I often think of a power of attorney, having a power of attorney for yourself that you've named somebody to act in the event of your incapacity. It's almost like having a life jacket handy. And you need to have that handy because your loved one needs you to be prepared. So this power of attorney can contain provisions for not only taking care of your own financial assets and paying for items that you will need, but it also can have specific terms about gifting and trust creation. Now, these additional terms are very specialized ones, and again, are ones that you would discuss with your personal financial planner. But the trustee and the power of attorney, the agent of the power of attorney, can work together, but in many instances, they need each other. So,
Thanks,
Debbie,
Elizabeth. I was going to say
on.
That's right. So, you brought up guardianship, and we introduced it before. We're going to show this next slide, which is a question from a viewer. That's basically anything special to consider when setting up a trust for an 18-year-old grandchild with profound autism. And so our next slide really highlights what a guardianship is and why you might need it, and circumstances where you might need it. So we discussed trusts, we discussed powers of attorney thus far, but now we're really going to introduce guardianship for persons with special needs. And as Elizabeth mentioned, guardianship authority is different from trustee authority and power of its attorneys. So a guardian, and you might know this from the news, is basically also known as a conservatorship, and it's a legal process that's undertaken when an individual cannot make sound decisions. That goes back to that capacity question that Elizabeth defined. So this process for guardianship includes citations, doctor's findings, and petitions to be able to seek a decree from the court. The decree appoints a person or an entity to be responsible for making certain decisions on behalf of the person. And as illustrated here, a guardianship includes two capacities: guardian of the person that attends to the personal and medical needs, is highlighted in blue, and then guardian of the estate, which attends to certain legal and financial decisions, shown in gold. Because guardianships are restrictive and they take away from the freedoms of the individual to make decisions, guardianships are monitored by the court. As highlighted in the question above, guardianships become especially important when an adult person cannot handle their affair and they didn't execute a power of attorney. Guardianships are also crucial if you have a minor child, which is under 18 in most states, with capacity, with limited capacity too, and that is turning age of majority. Again, 18 in most states. So a guardianship can provide the authority that's needed to help a loved one who does not have capacity and cannot make sound decisions. This guardianship degree can be in conjunction with the creation of a special needs trust, both first party and third party, but it is not in conjunction with the power of attorney. So that's kind of important there, which is a guardianship supersedes any power of attorney. In essence, to summarize and restate authority, a trustee controls a trust, a guardian controls the guardianship estate, and a durable power of attorney may control non-trust assets and non-guardianship estate matters. So earlier we kind of commented on adults or someone turning 18, but what about minor children or minor children with a disability? For children under the age of majority, again, whether special needs or not, the parents are generally considered the natural guardians and court involvement is not yet needed. However, if you find a circumstance, and we did receive questions on this, where a parent of a minor is unable or unfit to serve, a court-designated guardian may be appointed for the minor. Also, in circumstances of a predeceased parent, kind of tying back to our traditional estate planning documents at the beginning, the court would look to see if a guardian was named in the will and designated for the minor child. So we want to shift our discussion into the key considerations for financial planning, because a lot of questions came through on, and we'll move to the next slide, how much do I need? And so this next slide shows, how much do I need for my brother's lifetime? He has a disability. On the next slide, we have a statistic from the U.S. Department of Agriculture for 2021 stating that raising a child is estimated at about $233,000 to age 18. But for parents with children with special needs, that's a drop in the bucket. And their loved ones' expenses continue beyond college age 22. So Autism Speak, for example, put the cost of raising a child with an intellectual disability that's nearly twice the cost of raising a child without an intellectual disability. And that lifetime care amounts to about $2.3 million. So for families, these lifetime expenses to raise and care for their loved ones can be overwhelming. And there is assistance available for families, and it comes from both state and federal programs, which we're going to discuss. When you think about caring for a family member with a disability, our recommendation is to begin with a thorough needs assessment. And we'll just move to the next slide to show you what we mean by that. Families really need to contemplate what are the medical needs, what are the living and transportation needs, what's the capability of living on their own or with some help? Is it likely that they can hold a job, either full or part-time? Will they need special education or special training? After this assessment, ideally, a family can turn to a life care plan, and that's on our next slide. Perhaps the most helpful way to assess needs is with a life care plan. This document identifies a person's future medical and supportive care needs. A life care plan is in consultation with families, doctors, case managers, attorneys, trust officers to coordinate the support for the loved one. A care plan can also be used in legal settings to accurately project the nature and cost of an injured person's long-term care needs. So before we think about how much this will cost a family, we really want to understand governmental benefits. And I'll turn to Sheila and the next slide on this question, which came in from a viewer. What government resources are available to a person with special needs?
Let's look at needs defined. When talking about government benefits, a phrase that usually comes up, and one of them is needs-based, means tested. The term needs-based refers to the fact that Medicaid and certain programs are only available to certain people who meet eligibility requirements. Medicaid is also based on a person's income and asset or means. It's best that you contact your local Social Security office to find out if you would qualify based on your specific need, since the income limits change year to year and state to state. Let's look at Medicare and Medicaid on the next slide. Medicare is a federal program that provides health coverage to seniors age 65 and older or under 65 with a disability, no matter the income. An individual of any age with a disability who receives Social Security Disability Income or SSDI must wait 2 years to apply. Medicare covers routine and preventative services, but it does not cover long-term care. Medicaid covers routine and preventative services in addition to the possibility of long-term care. You will note with Medicaid, Medicaid is a program managed by both the state and the federal government. It serves low-income people of any age. Keep in mind that each state sets its own guidelines regarding eligibility and services. It may include long-term care. Let's review other medical benefits that are associated, such as social programs, on the next slide. Public assistance. What could be considered medical public benefits? Medicaid benefits include services such as inpatient and outpatient hospital services. This could include physician services, specialists, laboratory testing, and surgery. In-home nursing services can be expensive. Having a nurse in the home on a 24-hour basis can cost over $500,000 a year or more. If approved, Medicaid may cover the cost for nurses in a home without the need to deplete the assets in the trust. Let's look at John, who has a trade and has a special needs trust established, which was established when he was 25 years old after he received a large settlement from a medical malpractice lawsuit. John's condition has deteriorated to a point where he requires a nurse at least 16 hours a day in order to remain his independence. Medicaid may cover the cost of his in-home therapy, which could include occupational physical therapy, as well as hours towards the nursing care at home. Now let's take a look at non-public, non-medical public benefits on the next slide. An individual qualifying for public assistance may also qualify for cash assistance, help with their utility bills, and if needed, public housing. This is particularly, there may be a particular need for housing due to the disability. Federal statutes have been created so that Medicaid will comply with an individual who may be struggling with addiction or mental health issues. These individuals may qualify for Medicaid's behavioral health services, which may include mental health and substance abuse programs. Seniors suffering from dementia may qualify for adult day programs and workshops, which allows their caregivers some respite and also allows the seniors some additional stimulation and recreation. Moving to the next slide, let's look at other options for living. An S&T Special Needs Trust allows for the preservation of assets for supplementing medical services, but it could also be used to improve the quality of care of the beneficiary. This could include the purchase of an accessible home or the modification of an existing home. It could include the purchase of an accessible van or vehicle. It could also include covering additional respite.
Thank you, Sheila. I get involved, and outside attorneys get involved many times with first party special needs trust when there appears to be a need to purchase a home or a van. Given the cost of a house, many times principal of the trust, of the first party need trust, will be needed to purchase it rather than being able to solely rely on the income of the trust. When I say income, I mean the interest and dividends. This means that in many states, court approval will be needed to purchase the house, even if the trust specifically authorizes such purchase by the trust. Sometimes, usually, Department of Health and Human Services will need to approve the purchase and the use of the trust assets since it's such a large amount. When an S&T owns a house, it is important that the trust has sufficient funds to carry all of the expenses of the house, or that some arrangements are made and planned out in advance for how those expenses will be covered. You will also need to consider who else may be living in this house, especially again if it's a first party special needs trust. Because remember, only one beneficiary can benefit from the first party special needs trust. The first party special needs trust can, and the law does permit someone also living in the house who's directly assisting the caregiver, the special needs person. But when it goes beyond a certain number of members of other individuals, court approval arrangements may be necessary, which could include separate legal documents. As to the van, the trust may pay for a van, but the trust would not want to own the van. Frequently, the van is purchased and the caregiver owns it, subject to a lien that the trust holds on the van, because vans are getting to be extremely expensive, just like cars. And I'm sure when Sheila, you can share your recent experience on the cost of them. But before you do so, let's go to the next question. And then the next slide. What is the difference between SSI and SSDI? Sheila, can you answer that question?
Yes, thank you, Elizabeth. And yes, the vans are expensive, one costing $107,000. But moving on to the next slide, in supplemental security income. Unlike Social Security benefits, supplemental security income benefits are based on your prior work history. Unlike Social Security benefits, SSI benefits are not based on your prior work or family history, but is financed by funds from the US Treasury. Supplemental security income, and once again, it's means tested program. The program is administered by Social Security, and the benefits are paid to individuals with limited income and resources who are disabled, blind, or age 65 or older. The benefits are intended to cover food and shelter. To remain eligible for supplemental security income benefits, your countable resources must not exceed $2,000. In many states, SSI or supplemental security income recipients automatically qualify for Medicaid without the need to fill out an application. While in other states, your SSI guarantees eligibility, but you still need to apply. In a few states, SSI does not guarantee Medicaid eligibility. When considering whether you qualify, it is always best to contact your local Social Security office directly regarding your individual's qualifications. Moving to the next slide. Many have asked about the differences between SSDI and SSI. SSDI, or Social Security Disability Income, supports individuals who are disabled and have a qualifying work history, or they have a family member who has a qualified work history, while SSI provides basic financial assistance to older adults and individuals with a disability, regardless of their age, but they must have limited income and resources. The major difference between Social Security Disability Income and SSI, or Supplemental Security Income, is that the SSI determination is based on age of disability and limited income and resources. However, SSDI is based on disability and work history credits. A person qualifying for SSI will automatically qualify for Medicaid. A person with SSDI will automatically qualify for Medicare, but only after receiving SSDI benefits for 24 months. Debbie, we've covered the public benefits available to qualifying individuals. The next question an audience member had is, what does funding a trust mean and how is it done?
Thanks, Sheila, for rolling through all those different benefits. It's good to have it all in one place. And it's true, the economic burden incurred, I'll go to the next slide, incurred by families as a result of caring for persons with disabilities can be substantial, even with the help of government programs, especially among families who are caring for the severely disabled. Starting with social services is helpful to families trying to identify resources that will support long-term financial needs. However, families quickly learn that certain treatments, therapies, or programs are not covered by insurance, or perhaps their school district. This is often where the family's ability to contribute becomes important. Take time to itemize your family's assets, liabilities, income streams, and annual expenses, and contemplate, what are the family resources? What's the plan for the death of a parent? Is there family support? Is there full life expectancy? A financial plan is recommended to project the needs of your family and your loved one throughout everyone's lifetime and the probability of success for financially supporting those needs. Once you understand a realistic goal that you're trying to meet, you can strategize on how to achieve it. So we'll go to the next slide. And as we stated earlier, a third-party special needs trust is usually established by parents or grandparents, and it can be created at lifetime or at death. To create the fund, first, you must go to an attorney and have a trust agreement properly drafted with the correct language. Then, the trustee must accept appointment, attain an EIN, which is a tax identifier for a trust, and create an account at a financial institution and deposit funds into the account. Depositing into a special needs trust can include cash, stocks, bonds, real estate, proceeds from a settlement, life insurance proceeds, and potentially retirement assets. Other family members or friends can assist by adding assets into the trust by making gifts to it. Keep in mind, gifts should be made into the name of the trust, not to the special needs person. For example, you'd make a gift payable to the John Smith Special Needs Trust instead of John Smith. Testamentary gifts or gifts at death can be added into an existing trust. For example, if a grandparent passes away and they wanted to provide for their special needs grandchild, they can add a provision in their will and the executor will complete the gift on behalf of the deceased grandparent. When considering the amount of funds needed for special needs persons, families look to their largest asset, which is usually their home or a retirement account. The family residence, which may be the only home the special needs person has ever known, can be added to a third-party trust. The title on the deed can be transferred into the name of the trust as a gift from the homeowner. If for some reason the special needs person must move or sell the property, the proceeds remain in the trust. Also, when a trust terminates, the other beneficiaries, known as the remainder persons on a third-party trust, will inherit any remaining assets after all debts and expenses. We're going to cover this, what happens when a trust terminates, later in the presentation. But let me move over to IRAs and we'll go to the next slide. I mentioned funding a trust with a retirement account. And by that, you would, after your use of the retirement account, name the trust as a beneficiary. Most individuals have most of their life savings in their retirement account, and upon their death, it could provide for an influx of funds for a special needs person. Designating a special needs trust as a recipient of a retirement plan is tricky under the current Secure Act, which became effective on January 1st, 2020. With this newer legislation, there are unanswered questions regarding special needs trusts as beneficiary, which have to be addressed by the Internal Revenue Service and the Treasury in the form of regulations. Unless carefully managed, good intentions without the proper advice could disqualify a special needs person for their government benefits. So please seek professional advice before naming a special needs trust as a designated beneficiary. And Elizabeth, I think you mentioned there was just some kind of current topic regarding retirement accounts and special needs trusts.
You're correct, Debbie. There's some recently issued regulations, and they come in the form of proposed regulations. And as I was saying to you earlier, I think that's going to be what I'll be doing in my next chunk of free time very soon after this, and reviewing them and seeing what's available. It's an example that the law is constantly changing and being updated, so that you need proper planning and advice all along the way. It is not unusual for someone to go to an attorney, even a special needs estate planning attorney. The attorney drafts a wonderfully worded documents, various documents, wills, trusts. Client signs, executes them correctly according to make them valid under state law. And all of that is done, but then they decide to skimp either for finances or say, oh, this isn't that important. And they do not have the attorney prepare or review the beneficiary designation on an IRA. It happens all the time. So it's worth it to take this extra step. It's also important with IRAs that the trust be drafted correctly, because it's in the top of special needs trust language. It's also special IRA language. And so there are real opportunities with use of an IRA to fund an S&T, since a disabled beneficiary is considered an eligible designated beneficiary of an inherited IRA. And that's being explained in these new proposed regulations. But what this means to you is a person through the trust potentially could use a longer payout for the distribution of an inherited IRA over the course of a lifetime instead of a 10-year payout for most individuals who inherit an IRA. So let's move on, Debbie, to another area which is very important for beneficiary designations.
That's right. We'll move to the next slide. And you're so right that IRAs are complicated, but this is an effective strategy for funding a special needs trust. And it's when you name the trust as the beneficiary of a life insurance policy. So in this illustration, the insured person, it could be a parent or a grandparent or whomever you decide, names the trust as the beneficiary to provide additional assets into the trust at the time of the insured person's death. Keep in mind, again, you need to make sure the application with the trust company has the beneficiary as the trust and not the special needs person's name. And there's two other quick notes here, just trying to tie it all together for the viewers. Both retirement accounts and life insurance do not follow your will. Rather, they follow a beneficiary designation that's registered with the financial firm. In other words, your 401k administrator or your IRA custodian or trustee and the life insurance company. So make sure that your beneficiary designations are correct. Just updating your trust or your will not update a beneficiary designation. And then the other important thing when we think about family support of a special needs person is that if you're the wage earner and you're helping to provide financially for a special needs person, please consider purchasing long-term disability insurance. We often see the scenario where one parent earns the salary and the other parent is the caregiver. Disability insurance provides some income for the wage earner if they become unable to work and create some financial protection. So we're going to move on to the next slide. And we received this question from a parent looking for some financial autonomy for her daughter. What type of bank account can I set up for my 32-year-old daughter with the disability so she can control a small amount of money without endangering her government benefits? Her only income is SSDI because of my SSI and the money from insurance settlement, which goes directly into her SNT. So on this next slide, we're going to introduce the ABLE account. Our focus in this presentation has been pretty much on special needs trust planning, and we wanted to provide a quick overview and bring to the attention of the audience the ABLE account. So in 2014, new legislation was enacted to create a tax-advantaged account for individuals with disabilities known as the Achieve a Better Life Experience. The ABLE account recognizes the significant costs of living with a disability. And the legislation was enacted to help secure funding for a disability-related expense to, again, supplement but not supplant the benefits provided through the private insurance company, Medicaid, supplemental income, and perhaps the beneficiary's employment, if any. So the ABLE Act entitles one account per special needs person if the disability had an onset before age 26. If the special needs person is receiving SSI or SSDI, they're automatically eligible to establish an ABLE account. There are annual contribution limits for those amounts, and they're adjusted periodically for inflation. And please know that each state has a limit for the total allowable funds that you can have in an ABLE account. So I'll take you to the next slide and just sort of highlight again some of the benefits to the ABLE alternative. The cost of establishing the account will be considerably less than a special needs trust or pooled income trust, and funds grow tax-free. The account will provide more choice and control for the beneficiary and is an easy application. Government benefits are protected with this account registration. And finally, the family can decide to have both a trust and an ABLE account. So we've discussed how to financially support a special needs person, but we also want to provide information on administering the trust. And on this next slide, Sheila, we received this question from a family member who asks, how does a special needs trust close?
Thank you, Debbie. Thank you for that question. One of the questions I'm asked regularly is, when does a special needs trust terminate? A special needs trust can terminate upon the passing of the special needs beneficiary if there are any changes in the law or if there are changes in eligibility for public benefits. The beneficiary may have improved to such a degree where they no longer meet the standards for disability. We'll focus on the passing of a beneficiary. In a first-party self-settled special needs trust or pooled first-party trust, once notified, the death certificate is requested and the letter is sent to the appropriate state Department of Human Services to obtain a final statement of claim. Once the final statement of claim is received, the lien is paid. However, prior to the payment to the state or states, all state and federal taxes and administrative expenses are satisfied. It is always preferred that a prepaid funeral arrangement, either established by a provision in a document and approved by the Department of Human Services, General Counsel, or as approved by the court by court order, is part of the special needs trust planning process. If necessary or required, an accounting is prepared and filed with the court. If there is a balance remaining after all expenses outlined in the trust have been paid, including burial expenses, the balance remaining is paid to the intestate heirs. In a third-party special needs trust or third-party pooled special needs trust, upon notice of a beneficiary's passing and receipt of the death certificate, final expenses as outlined in the trust are paid, including taxes and funeral expenses, if a prepaid was not previously established. The balance remaining is to be paid in accordance with the governing trust instrument to the named beneficiaries. Now, Elizabeth, I know you had some comments.
That's right. That's right, Sheila. And I do want to emphasize, and when we were putting this program together, we were thinking about it. We do have instances in which, as a result of the beneficiary, the care and love and support of the parents, special programs that they've been able to obtain, that they really do advance far beyond what was initially diagnosed. And so the times that the S&T is maybe spent down to improve the quality of life for the individual during lifetime. And it ends up being not that it terminates because of one's passing. So there's some happy stories there too with the termination of S&Ts. However, in this area, like any other, you want to be very careful. Do not spend down alone. Do so on the advice of counsel, careful reading of the particular law in place at the time and the terms of the trust. Sheila, do you want to wrap us up?
Well, in summary, we've discussed the various trusts, trust definitions, trust terms. And I think it gives you a basic understanding of how to go about planning for your loved ones.
That's
Visiting
right.
an attorney, creating a plan, and revisiting your plan on a regular basis so that you take into account the different phases of your loved one's life.
Thank you, Sheila. Now, Adrian, I think we have some questions in the audience. Would you like us to read the questions that have come through? I think the first one might be, can a special needs person have more than one S&T? Debbie?
I'm happy to take, yeah, I'll take that one. Sure. Yes, you can have more than one special needs trust. It's important not to commingle a first party and a third party. So to the extent that you have both a first party and a third party, you will need to have two trusts. But to the extent that you have more than one third party, so say a parent creates a trust and a grandparent creates a trust, those can be commingled. And I've actually seen it, maybe Elizabeth, you want to comment on this, where a grandparent set up a special needs trust, but perhaps didn't know that the parents of the special needs person also created one. So you can actually go to court to push those two together based on your state. And the other thing I'd say about creating more than one special needs trust is there's a cost, there's an efficiency and a cost efficiency of not having too many trusts. And lastly, you want to consider financial planning when you think about having more than one trust. And that's because you may want to think about if you're overfunding, so you want to do the work of contemplating the needs, the assessments, how much things cost, look at the life care plan, do a cash flow analysis, do a Monte Carlo analysis so you really feel comfortable about providing for your loved one. And that includes your loved one with a disability and your other family members.
Excellent.
Those are very good points, Debbie.
Thank you, Debbie.
And very good. And as far as combining the trust, many times in more current estate planning documents, wills that set up a trust or a deed of trust or a trust agreement, there's a specific provision in the document that a trust created under such document can be combined with another one as long as they're essentially very close, the terms of each are very close in nature. So coordination, it's not just coordination among the advisors, it's also, if possible, coordination among the family members. There's one thing I too want to add on that question before we go to the next one, is that a lot of these requirements that we've been going through, that Sheila, with those extensive about the first party special needs trust. First party special needs trusts are much more involved. There's much more involvement with the courts, many more requirements and restrictions. They're wonderful way to hold a lawsuit settlement because many times it's because of some injury, personal injury, that the person has a special needs trust. So that's the vehicle, and it's really the only vehicle in that situation. But there again, you want to have proper planning on the front end so you don't end up having what we call postmortem planning after somebody's passing to have to do something because it was otherwise assets by a grandparent were left outright. So another question we got, and I will answer this one, is do people in Delaware have any specific considerations for S&Ts? And this question really returns to my opening comment. Each state has different laws. Some counties even have slightly different benefits, especially with respect to educational benefits. I've seen it that families have moved from one state to another because they want to take advantage of the educational benefits in another state or some other type of public benefits. So what I suggest if for the person asking this question is that they make sure, whether it's in Delaware, New Jersey, Pennsylvania, that you go to an estate planning attorney who specializes in special needs trust creation and is familiar with the Delaware courts. I have seen at times that it may not be, and it's maybe just from a situational aspect, as much emphasis on restrictions of use of principle as I have seen in Pennsylvania and other states. But on the other hand, there seems to be requirements to file annual reports for trusts at times in Delaware, almost like a guardianship. And then also you have to make sure that the trust is drafted as such and that you have the appropriate trustee so you don't have to run into the bonding requirement, because that's something that can vary from state to state and even from county to county. So we have another one here, and
We might want to check our time, Elizabeth, and I just want to chime in one quick thing, which is we're in the tri-state area, so it's important for families to think about, especially if you have an adult person with a special need, they might want to live in a different state than where they grew up. And that's not an easy decision for families to make, but it is something that occasionally does happen. So maybe we should turn it over to Adrian and see how we are on time.
Yeah, well, first of all, thank you, Sheila, Debbie, and Elizabeth. This has been phenomenal, and we're really looking forward to continuing this conversation by sharing this recording with everyone. I did want to quickly note, looks like we have time for maybe one or two more questions, but I just want to quickly note that Natalie has put a link to the survey in the chat. So for those of you who are with us, we'd really appreciate it if you could click that link and complete the survey, of course, now or when you receive it by email. But we did get a couple more questions in, and if it's okay, I'll just share the next. We got this question: is the special needs trust appropriate for a minor whose living parent may not be responsible with managing money? Which I think is a very thoughtful and interesting question.
Well, I'll take that question. Without knowing the specifics of the situation or the disabilities involved, I would say yes, if the minor qualifies or has qualified for public benefits, it may be in the best interest to establish a special needs trust, because then it goes back to what was said previously about ensuring that the assets are used for the intended purpose, which is to care for or cover those expenses not covered by public benefits. So I think in that case, without knowing specifics, yes.
Great.
But I again urge, it's always best to speak with a planner with regard to your specific situation.
All right, so we have time for one last question. Can a special needs trust be used to provide for a spouse with dementia? I currently have a will that provides my husband a nice amount of money, which would likely go to a nursing home should I predecease him. Would a trust like this enable me to leave an equitable amount to provide for his care and leave a larger portion to our children?
I can take that question, Adrian. And the answer to this question in many ways returns to my opening comments. In many ways, this is an elder law, well, depending on elder law question. It may or may not be, because we don't know the age of the spouse, and so that could be a specific. Remember, for a special needs trust, if it were a first-party special needs trust, beneficiary can't be older than 65, but with a third-party special needs trust, age doesn't make a difference. In many ways, the qualifications for Medicaid are similar, but not exactly the same. And there again, this is one in which you need a specialist, and I would say more of an estate planning specialist who limits their practice to elder law and qualification for Medicaid, because there's certain obligations between spouses for each other, and you want to make sure you don't trip on a situation like that. And there's special rules, even with respect to who owns the house. So, so maybe some thoughts for another program, Adrian.
Yeah, definitely, especially if we get feedback on the survey that says this is what our audience wants to see. But I just want to thank you all. It looks like we're right at time. This has been incredibly valuable. And I also want to thank everybody who attended today from the WHYY community. Really grateful to Bryn Mawr Trust Wealth Management, and specifically to Sheila, Elizabeth, and Debbie for their time and for really thoughtfully answering our audience questions today. Thank you as well to my colleagues, Natalie Bissett and Tina Killickay, for their guidance and help in leading today's program. And we will be sending you an email, so please look out for that. And I thank you again for your support and your community partnership with WHYY.